So warm welcome to those of you on the telephone, warm welcome to those of you on the webcast, and of course welcome to those of you here in the room in London. There will be, as always, a Q&A session at the end of the presentation, and we'll be happy to take questions from the phone or from those of you on the webcast. Just follow the instructions you've been given. And of course, we will, as usual, give preference to questions coming from those of you here in the room. Here on the stage, we're joined by our CEO, Thomas Buberl, our Deputy CEO and CFO, Gerald Halin. And in the room, we also have our CEO for France, Jacques de Peretti, our CEO for AXA in Europe, Antimo Paretta, and our CEO for the UK and Ireland, Amanda Blank. So welcome to you all as well. And so, without further ado, it's now my pleasure to hand over to Thomas.
Thank you, Andrew, and good afternoon to all of you. I'm extremely happy to be with you this afternoon, particularly in view of the very good results that we have presented this morning. When we look at the key takeaways of the result, I would like to stress 5 points. The first one is, you have seen that we have published excellent results. This is a very strong earnings growth relative to last year, which has led the board of AXA SA to decide that the dividend will increase. The second important message is, if you look, where does the growth in earnings come from? It is not from one geography or from one operation. It is across the board, from all geographies that have contributed to this excellent performance. The third one is, many of you might say, well, on the revenue side you have been flat, but this was a very dedicated and clear decision to focus ourselves on more profitable new business and to deprioritize business that is not profitable enough. And this focus has really driven those strong results that we have published today. All of this has happened and will happen in the future on a very strong and reliable balance sheet. You have seen that our Solvency II ratio has again been reinforced, and this is also a very good basis for a very strong cash generation in the group. For the first time, we have also published health separately. I know this was a big desire of yours, of some of yours, over a long time. We have done it because health for us is very important. It is a big ground for innovation. We have certainly moved on with some very tangible results. And health is not only a question on the insurance side and innovation side, it is also a question on how are we behaving as a social actor when it comes to investing. And also on the social acting side and being a responsible citizen, we have taken some very clear measures when it comes to our investment focus and sustainability. If I start with Ambition 2020, in June 2016, we have launched Ambition 2020. 4 major targets were attached to these objectives of Ambition 2020. The first one was underlying earnings per share. We said our ambition is, despite the fact that we have a negative impact from capital markets, we want to achieve an underlying earnings per share growth between 3 and 7%. In 2017, we have hit the absolute top of this range with plus 7%. A second important target was the free cash flow. We set ourselves the objective, based on a remittance ratio that is quite high, to get to a cash generation capabilities over the period of 2016 to 2020 of 28 to 32 billion. 2017 has been a year of a generation of 6.3 billion, again well in line within the target range that we have set ourselves. On the adjusted return on equity, we set ourselves a target between 12 and 14%, and in 2017 we have even overreached this range with 14.5%. On the solvency side, I commented earlier on it, we have a target range between 170 and 230. We are spot on in the middle, slightly above the middle, with a very proud 205%, which is an increase compared to last year. When we look at the underlying earnings, we can see a strong growth of 7.5%, which has led to an underlying earnings per share growth of 7.3%, right at the top of the range that I indicated just earlier. On the adjusted earnings and the net income, we see a very similar tendency for the first time, 7.6% on the adjusted earnings and 8.5% on the net income. 6.2 billion on the net income is also the first time that we have surpassed the threshold of 6 billion in the history of AXA. When we look at the adjusted earnings per share, which is the base for the dividend, we can report 7.6% growth, and this has obviously led to the decision of the board of AXA to say we want to increase the dividend. We want to increase it from 116 to 126, while at the same time increasing our payout ratio from 48 to 49%. With those 49%, we are still in the guidance range of 45 to 55%. I said earlier that this result has been fueled by a very good performance across all the geographies that AXA has. And maybe you notice here that we have for the first time now changed our reporting from a line of business reporting to a geography reporting. This goes very much with the simplification of our organization. Last year in November, on the 14th of November, we have announced that we have changed our organization away from a very complex regional and line of business organization to an extremely simple organization that is based on geographies. When you look at those geographies, you can see that France, which is our stronghold, which makes roughly 20% of our overall result, is a very strong contributor to the overall results. We are a strong market leader in France. We are in the top 3 everywhere. And despite the fact that we are big, we are still gaining market share. Why is that the case? Jacques and his team is extremely innovative, is extremely well positioned when it comes to product innovation, when it comes to distribution, and they can really reap the benefit of this great positioning. The same is true when you look outside of France into Europe. Again, Europe with 2.3 billion underlying earnings is a very strong contributor, has grown by 2%. And when you look across these markets, you see that AXA has extremely strong positions. Number 1 in Belgium, number 1 in Switzerland, number 5 in Germany, very strong in the UK when it comes to health and commercial line, number 2 in health. So very strong positions. These have helped us to really grow, to really improve, and also to make sure that the business mix has shifted in the right direction. We've often heard about the fact that Europe is not so strong and that the emerging markets bring all the new profitability. If you look at our experience, this is not true. Europe is strong, Europe is alive, and we are also happy that the core of AXA is alive and brings good results. Nevertheless, outside of Europe, we also have 2 other strong footholds that are very important for us. One is the US. In the US, we have a very strong position in the retirement space, in the teacher segment, and also in the asset management with AllianceBernstein. The US has experienced a very positive year with plus 16% of underlying earnings, where it's really a great story. When we look into Asia, we also have a very unique positioning. We are the only company that is a multi-line insurer there. We are the only company that plays in the bank assurance and the agent channel, a very strong positioning, where we have really focused on fewer countries to really fuel the growth there. There, we clearly need to continue working on our business mix, continue working on our growth. I would have loved to see more growth there in 2017. On the international businesses, which is all the other countries, we have also realized a significant improvement in the underlying earnings growth of 20%. Those are the markets of tomorrow, but those are also the markets that we need to streamline and need to decide where are we staying in and where are we going out. And you have seen that we mean it. Yesterday we have announced one disposal in Azerbaijan, and we will continue working on those portfolios to manage the profits and manage them for profit, but also to rationalize our footprint. When we look at the business mix, I'm extremely proud that we have continued to optimize our business mix. And despite the fact that some of you in this room have said, look, at 40% NBV margin, it's over, not more is not possible, we have seen that we have proven the opposite. We have gone from 40 to 43.1, again with a further shift towards protection, towards health, and towards unit linked. This obviously has a consequence on the growth, because if you focus yourself on one area and more or less exclude other growth areas, it does show in the growth, but that doesn't matter. We need to continue this journey, and we need to really make sure that despite rising interest rates, we stay disciplined and we show an improvement year after year. When we look into the profitability of the other lines of business, P&C, protection and health, we can also see that our strong discipline in driving profitability has clearly shown in the combined ratios. We have worked hard on improving our loss ratios. We have been very disciplined, and Gerald will show that to you in a few minutes, on the question of how is our reserving, how is our prior year experience. We've been very clearly at the lower end. As I said earlier, health for the first time is fully separated. Health for us is a very strategic segment. We are the leader in health. We are very strong in 6 markets, and these 12 billion of revenues have grown at 6%, which is a remarkable figure. At the same time, the underlying earnings have grown by 11%. And we have continued to invest and to realize and build up our innovative scales. I would like to mention 2 important pieces. One is the acquisition of Maestro Health in the US. Maestro Health is a population health management company, so they are not an insurance company in the primary space, but they are a service company to help, in particular, companies to reduce their medical expenses. And I was very pleased to see that after we have realized that purchase, that 3 large US institutions have put themselves together to make sure that they work on exactly that topic. That has shown to me that we are on the right journey. The second element, which is not on the slide, but I'm also very proud of that, is that we have now, over 2 years, ramped up our telemedicine operations in various countries. Today I can report back to you that 10 million beneficiaries have access to that telemedicine. So it's really something very different. It is something that is very convenient for the customers, because in the first instance, with the first call, we can resolve 70% of the issues. And these are the first steps among many others that I can't talk about now because we have no time, that we are making from really moving from a payer to a partner. As a very large investor, we also have to ask ourselves the questions, what can we do to help society to live a better life? And what can we also do to influence the claims behavior that we're experiencing in a positive way? And clearly, you have seen we have a long track record of being very focused as a responsible and sustainable insurer, being focused on climate change, being focused on really providing people with a healthy life. We have started divesting from coal. We have then divested from tobacco. And we have taken a further step from divesting from coal. On the one hand, increasing our investments in green areas, 12 billion, which is 4 times more than what we had previously. Additionally, divesting 3 billion from coal and not ensuring any new production of coal. This is for us an absolutely core element, because our mission is, how do we empower people to live a better life? This goes with paying claims. This goes with helping people in their daily lives without having claims, but that also goes with investing in a responsible way. If I come back to Ambition 2020, I'm again very proud of these results. All of the KPIs that we have published this year are either in the range or at the top of the range, with 7% underlying earnings per share at the top of the range, 6.3 billion of free cash, 14.5% return on equity above our target range, and an extremely solid balance sheet of 205%, 8% more coverage than last year. I would now like to hand over to Gerald, who goes into more detail. Thank you.
Thank you, Thomas. So underlying earnings, according to, in line with our new format, but you will see later on that we have some reconciliations. What you can see is that, as explained by Thomas, we have an underlying earnings which is up 7%, and you can see that all the markets are up across the board. Let's start with, and let's go through all these markets, and let's start first with France. And in France, we have underlying earnings going up by 3%, explained by higher unit-linked fees in line with the market improvement, an improved loss ratio in protection, improved claims experience in P&C commercial lines, and this is offset by lower investment income, and you will see that across the board in most our markets we have lower investment income in line with our expectation. And also we have higher acquisition expenses, but it's quite normal because it concerns health and protection where we have strong top-line growth. Next, on the top right, you can notice the high profitability of our business in France, and you will see that we can make exactly the same remark as far as Europe is concerned. So P&C combined ratio 94.6, NBV margin 34.5 plus 3 points. Revenues plus 4% when we exclude a large pension contract at the end of 16, with 14% in health, 13% growth in unit-linked. Next is Europe, and in Europe it's almost the same story. Underlying earnings plus 2, explained by higher technical margin, notably in Belgium and Germany. Lower expenses because maybe you remember that in 16 we had an extraordinary amortization of our VBI in Switzerland, and we have a negative coming from lower investment margins. High profitable business, P&C 94.6% combined ratio, NBV margin even stronger than in France, 56.6% plus 8 points. And look at the bottom right, 84% of our revenues are in P&C, health and protection. Absolutely in line with our strategy, which consists in being less dependent from the financial markets, because the technical margin, as you know, are decorrelated from the financial markets. Minus 1% in revenues, mostly explained by the GA savings. And the minus 23 in GA savings, it's mostly first in Italy, because in Italy we have revenues down 12%, with, I should insist, a strong recovery in the second part of the year in Italy, thanks to MPS. You know that MPS had problems and difficulties in the first half of the year, but we have a strong recovery with most of a significant part of this new business done in unit-linked business, which explains also the plus 30% that you can see here. Next is Asia, and Asia underlying earnings are up 7%. I would say that it's explained by two main elements. First, improved technical profitability across the board among all the countries. And second, lower expenses, and that's mostly in Japan. Here again, just have a look at the combined ratio for health, 78.3%, NBV margin 70.6 plus 6 points. And again, look at on the bottom right, the circle, 86% of our production, of our revenue, are in P&C, health and protection. 1% economic revenues. In Japan, we were at minus 6%. Why? Because we had the drop in the bank insurance business, which was mostly GA type, general account type of business with whole life business, single premium whole life business. Why? Because there is a new regulation, and I mentioned it already for the first half, that impose the banks to disclose their commissions, and it's slowed down the new business. In Hong Kong, plus 2%, it's also due to a change in the regulation, as you know, with the decrease in limited commission in unit-linked business, which again slowed down the Hong Kong business, but plus 11% in high potential, which is quite good. Moving now to the United States, plus 16%. So United States, it's as mentioned by Thomas just before, it's our life business plus the asset management business of ABE. So here we could say that underlying earnings are growing significantly, plus 16%, explained by improved financial market conditions with higher unit-linked fees, with higher GMXB margin, technical margin, and higher management fees at AB. This is offset by unfavorable mortality experience and net unfavorable model updates. So APE plus 6% with a strong momentum, especially in higher sales in mutual funds. NBV margin plus 23.4, plus 2 points, and this most of these 2 points improvement correspond to the tax effect, because it's a net present value of future profit, and a tax, as you know, will drop in the US, explaining most of the 2 points improvement. Net inflows plus 12 billion, and management fees plus 2.7 billion. And it's a good news, meaning that for an asset management company, a lot of asset management companies today are suffering from decrease in their management fees. It's even the contrary here at AB, because they are moving towards a higher proportion of retail business versus institutional business, explaining this improvement in the management fees. International, so international, it's a smaller market, 337 million euros of underlying earnings, but UE increasing by 20%, with a higher investment and technical profit in Turkey. Turkey is back in black, and it was not the case last year. We have a current year combined ratio which is now close to slightly below 99%, which is good. And as you know, we have investment income which are quite high in Turkey, around 8%. Improved technical margin as well in Russia, and these two good elements, positive elements, are offset by Nat Cat charges in Mexico and Turkey. You can notice that revenues are up 2%, and excluding Turkey, I remind you, and we mentioned it for the first half, that in April 17, we have been imposed a 30% drop in prices in TPL, in third-party liability. So it's not the biggest business line in Turkey, but nevertheless, we suffered from this element. But it's progressively improving because we have the capacity to increase our prices by 1.5% per month. Next is the AXA IM, just to finish this review. Underlying earnings plus 16%. Reasons for these improvements are not very different from ABE. Higher management fees, improved cost-to-income ratio, and as you can see, good level of net inflows, 8 billion, and of which 9 billion in third party, and cost-to-income ratio going down from 70.2 to 70.8, meaning that in the end, we have an improved operational leverage. So I presented all these markets except transversal and central holdings because in this category, in this bucket, we have, which grows by 8%, we have AXA IM, I presented it already, plus 16%. But we have also AXA Corporate Solutions, which is our large risk company. Unfortunately, underlying earnings of ACS went down by 59% linked to the weather events and to the Nat Cat. And we have also AXA SA, and AXA SA had an improvement, and this improvement is linked to the 3% tax, because you know that previously we had a 3% tax on dividend, and starting from 17, we don't have this tax anymore, and you will see later in the presentation that in net income will benefit from the reimbursement of the last years of this 3% tax. Adjusted earnings explained mostly by plus 7% plus 8% underlying earnings, and also we have these capital gains, mostly in equities, 674. You can see that net impairments are significantly down compared to last year. The markets are quite good, and this improvement translates into lower impairments. That's for adjusted earnings. Now, net income benefit from this 8% improvement in adjusted earnings, and we have the different elements, starting first with this mark-to-market of derivatives, minus 357. It's mostly these derivatives who don't benefit from the hedge accounting. And we have also the change in fair value of assets, which are mostly mutual funds, which are not consolidated, and as a consequence, they are marked to market. This is due to the tightening of spreads, which explains the 222. So minus 134. Then we have the exceptional and discontinued operations, 124. I should give you 4 elements because we have a lot of big amounts offsetting itself. First, the US DTL. That means that, as you know, we have a net DTL position in the US under IFRS, which means that the drop in the tax rates makes that it was a good guy. 288 million from this coming from this US DTL decrease. On the reverse, in France, we have a net DTA position, which means that it was a negative from 191. And we have this refund of the 3% dividends that I mentioned before. It's a plus 249. Unfortunately, this has been offset by another element, which means that we are managing some annuities in France, and part of the indexation previously was paid by the state. We are referring to very old annuities dating from 60 years ago. And a good way for the French state to repay the refund of 3% was to stop paying this subsidy on annuities, which means that for us it's a negative of 206, which means that more or less in France, unfortunately, it was a wash. So, as a whole, nevertheless, after all these elements, we have integration and restructuring costs. You remember that last year we had significant restructuring costs coming from Germany, from Belgium. Now we are at minus 148, pretty in line with the usual rate. So, as a whole, net income is at plus 8%. Now moving to the underlying by business line, I would say it's the old format. And you can see that as a whole, we have plus 6 billion of underlying earnings, plus 7%. Looking and focusing on life and savings, it's plus 9%, with, I would say, higher management fees offset by lower investment margin. In P&C, minus 1% at 2.4 billion, with lower investment margin, but also some nat cat, meaning that in the end we are at minus 1. Strong growth in health coming from the top line as well as an improvement in the technical margin, and asset management plus 32% at 540 million, explained by higher management fees and also the operational leverage, i.e. the cost-to-income ratio going down. Let's move to this traditional slide. This one didn't change on combined ratio. So you can see on the left that we have a current year combined ratio going down by 0.1 points, excluding the natural catastrophes, it went down by 0.3. You can notice that we have prior year reserve developments at 1.2, minus 1.2% versus minus 1.3%. So we continue to take a prudent approach, and you'll get more details. Maybe you will have questions in the AFR report. And all year combined ratio moves down from 96.4 to 96.3. Let's move to the cost savings. We are on track. We achieved 0.5 billion after 0.3 billion 1 year ago. As a whole, we are quite confident that we'll achieve the 2.1 billion. And you remember that during the IR day, I mentioned to you this 0.3 billion savings coming from leaner central functions, which makes us even more confident that we'll achieve this 2.1 billion. Let's move to the balance sheet. And we are managing in our general account 575 billion euros. 82% are managed in fixed income. Nothing very different here. You can notice that we still have a duration which is pretty long, 8.2 years. What will, I believe, interest you is the yield on assets. It went down by 20 basis points in life, 10 basis points, 15 basis points in non-life, and the reinvestment yield has been 2.1% in 17. Let's move to the investment margin, and here you can notice that on in-force we have an average guaranteed rate of 1.8%, on new business close to 0.3, so we have some flexibility. This flexibility translates into the investment margin because the investment margin goes down from 73 basis points to 69. I just told you that investment income dropped by 20 basis points, so meaning that we had some latitude and flexibility in order to decrease the remuneration to our policyholders. You can notice here that we are at 69 versus 65 to 75 basis points guidance that we shared with you when we presented our Ambition 2020 plan. On the P&C yield, minus 12 basis points. I'm sorry, I mentioned to you minus 15, it's minus 12. Shareholders' equity, so it's slightly down from 70.6 to 69.6. On the right, you have all the moving elements, and adjusted ROE, as mentioned by Thomas, went up from 13.5 to 14.5%. Solvency II ratio, quite strong. It moved from 197 to 205. On the right, you have the sensitivity analysis, and operating return was 23 points. including 4 points of positive operating variance this year, meaning that it doesn't change. We shared with you that we were close to 20. Excluding this operating variance, we would have been at 19 points. We have the dividends, we have the market impacts, which was positive, and keep in mind that we decreased our sub-debt by 1.2 billion, and we had roughly 1 billion of buyback in order to offset the dilutive effect of the benefits of the stock options and free shares, performance shares. Strong cash flow generation. It's moved from 6.2 to 6.3 billion, and 78% of remittance ratio, which is within the target of 75 to 85. So I'll hand over to Thomas for the conclusion. Thank you.
Thank you very much, Gérald. As you have seen, the year 2017 has been a year of very strong earnings. And we've always said when we speak about the dividend, a dividend increase needs to be justified by very strong earnings. The board has taken the decision to increase the dividend in a very attractive way. All of these results, as you have seen, are really embedded in all geographies across all lines of business. And we have really implemented what we said, a clear and decisive focus on lines of business that are growing, that are more profitable, and that's the most important, are the closest to the customer: health, protection, and commercial line P&C. This is the driver of our results. All of this has happened and will happen on the basis of an extremely strong balance sheet, where we have again shown that we have improved our Solvency II position by 8 points to 205, which is also the motor of a very strong cash generation with 3.6 billion. And we have continued our journey in the innovation. We have implemented many innovations. I have shown you a few ones in health, which I'm very proud about: acquisition of Maestro, movement into telemedicine with great success, and also a very clear and strong and decisive act when it comes to our investment policy as a sustainable actor of society. Thank you very much for your attention, and we will now go over to your questions. As Andrew said at the very beginning, we are starting with the questions in the room, and we'll then see if there are questions in the webcast. Let's start with Nick.
Nick Holmes at SocGen. I had a couple of questions on health insurance. Firstly, can you tell us more about your plans to grow the health business? I mean, Maestro is obviously a very interesting acquisition, but it's relatively small. I mean, what sort of appetite do you have geographically? Where would you focus? Things like that. And then secondly, on health, just out of curiosity, do you see it as more P&C or life insurance? You're recategorizing a lot of your business. Just wondered what your thoughts were on that. And then just one very quick additional question, which is, how much has the recent volatility in markets hurt your unit-linked growth, which of course has been so strong? Thank you.
Thanks, Nick. So I suggest that I'll take the first two questions and Gérald takes the third one. And while Gérald is looking up the effect, I can answer the first two questions. Your first one was around growth in health. Thinking back, we have 6 countries where we are very strong in health, one of them being in the UK. Our aim is to really gain market share in these countries and grow our health franchise with very innovative products. When you start in the UK, we have been gaining market share as the number 2 in the market because we are very innovative and very close to the customer with a lot of innovation. If you go to Germany, which is another stronghold, we have been gaining market share and climbing up the ladder. And you can look at this for all these 6 geographies. The key is, how can we grow with our customer base? How can we grow with services around our customer base? And if you look into Jacques de Peretti's business in France, they are already strong leader in health. The fact that they have added wellness and telemedicine into their corporate offering has increased the retention and has also increased their chances of winning business. So there's a very strong focus in those 6 countries. Everywhere else where we are not strong yet, there is a growth focus on health. If you are in Nigeria, or you are in Indonesia, or you are in Thailand, or you are in China, or you are in Mexico, people will always talk to you at AXA about a focus in health, always with the question, how can we grow in the base coverage, but also how can we grow in the services around it? And the services question in Mexico is a very different one as an answer to the one that it is in Nigeria, where you have no medical infrastructure or insufficient medical infrastructure. Your second question was around which type of business. And we have obviously individual business, group business, P&C, and life-like. My preference is to grow more in the individual business, to grow more in the P&C-like business, because if you look at the target segments and target lines of business that we have chosen, health, protection, and the P&C commercial, this is basically all insurance risk and a very P&C-minded look at insurance, because protection at the end of the day is the P&C part of the life business. Gerald.
Yeah, your question about the recent volatility in unit-linked growth. No, we didn't suffer so much from this volatility. I remind you that we had a quite good start in France, and Jacques could comment on this. We have a good momentum in the US, and you know that France and the US are the main countries for unit-linked. Keep in mind as well that if you take the example of France, we don't sell exclusively equity products. So we have structured products, we have different kind of products which smooth the performance, making that in the end we don't suffer too much from this volatility. Clearly, I remind you that in France we have 40% of our individual revenues for individual savings, which are in unit-linked, and this is not something which is declining, not at all.
Let's stay there and go this way. I think, Andy, you are the next one.
Thank you. It's Andy Sinclair from BofA Merrill Lynch. 3 questions, please. Firstly, jumping to slide B62, if we can. I was just looking at the comments on the US cash remittance there and just wondered if you could give us any update on what that means for the pre-IPO transactions. Secondly, just wondered if you could quantify your net M&A budget that's unspent over the last couple of years, given that you've done quite a few disposals as well as relatively few acquisitions. And when do you really feel you're sitting on too much? And third, just wondered if you can give us any guidance on the outlook for the US tax rate. Thanks.
Good. So I suggest, Gerald, you take the first question and the third one, and I'll give a go at the second one.
Okay. So starting first with page 62, B62. So out of the 4.9 billion, we have 0.8 billion roughly coming from the US. That means that we have injected 0.8 billion in the US, but the equity part, that means that in order to reinforce the equity, we initially told you during previous meetings that it would amount to 1 billion, and it will be much smaller, it's 0.3. And the rest, the 0.6, will be repaid in 18. So meaning that the impact of the recapitalization of the US is smaller than what we could expect a few months ago. US tax rate. As far as the US tax rate is concerned, will benefit I would say, I mentioned in my presentation the one-off effect on the net income. So this being said, this is a one-off effect due to the fact that we have a DTL position under IFRS, and moving from 35 to 21% is a good guy. At the same time, going forward, we can expect to have to benefit from this lower tax rate. This benefit, I would say, it's it cannot be so precise because it's a bit complex, but let's say that it could be north from 50 million.
Sorry, what was that?
North from 50 million euros.
Okay, thanks.
On the second question on M&A, in the Ambition 2020, we have stated that we have a yearly net M&A budget of 1 billion, which should result also in a 1% underlying earnings per share increase. When you look over the years, you're absolutely right. We have done some smaller disposals. We have also invested some money. I mean, if you look, we have bought Maestro Health. We have done some share buybacks on the Delusion side. Last year we did a little bit more. And we have hopefully an event coming up that will give us more means to redeploy capital, which is the US IPO. Our policy on M&A remains unchanged. If we have the means and if we see interesting and attractive objects and investment opportunities, they will only be looked at in the focus areas, health, protection, and commercial line P&C, in our focus geographies, the 10 big markets, and the 6 high growth market. That is unchanged.
So, sorry, just can you give us a figure for what's left then of the net M&A budget?
You can. Gerald, do you have a figure?
Give me a few seconds and I will give you a precise figure.
Sure.
Good. We'll come back to your question in a minute.
Yeah.
Appreciate it. Thanks.
Let's continue with James.
It's James Shuck from Citi here. I had 3 questions, please. Firstly, in terms of capital allocation within the group, you've changed the disclosure somewhat and you're focusing much more on capital efficiency. I'd like to get some insight into what the regional return on capital employed is, where there are underperforming areas and what your actual process is for allocating or freeing up capital within the group, and also kind of within that, if you're able to give any indication of what the capital is that actually is residing within the smaller entities that you identified at the Investor Day, the 26 or so that are there. Secondly, the growth outlook, so kind of 6 or 7% of EPS growth is the target, which you're kind of well on track for doing. I kind of look at France and Europe ex-France, and they're growing at more like 2 or 3%, and they had a bit of a boost from fee income from higher markets. I would have expected France to be growing a little bit quicker than that. I appreciate it's a competitive market, but it's the digital poster child for the group. Do you expect it to be growing at the kind of group levels? Do you expect Europe to be matching those group levels? And if so, when can we expect that acceleration to come through? And then my final question was just on the operating variances within the AFR, because the operating variances have been driven largely by a positive revision to the best estimate liabilities over IFRS, which is mainly driven by Switzerland, UK, Italy and Spain. I'd be interested to know what the drivers of that were and why we haven't actually seen it come through in the IFRS PYD.
So I suggest, Gerald, I will take the first 2 questions and you'll do the third one. When it comes to the capital allocation, so we have a very clear framework of how we allocate our capital and also how we manage the companies. And essentially, what we do is we look at every entity, how their return on equity is. Is it, first of all, above the capital costs? And then is it returning the way we want to return? And this is also then split by line of business. And that is how we manage the entities. There is a CEO dialogue with all entities every half year, where we basically have a look at these numbers and have asked those entities to give us a clear idea and clear measures of how to improve the return on equity. The new organizational model which is called freedom in boundaries, where we have a lot of empowerment locally, but where we have, on the one hand, a very clear competence in the center for allocating the capital and also for allocating the investment means. This enables us today to really give the capital where we have sufficient returns, above clearly our capital costs, and in decent markets where we are very happy with the returns. And that also will then make the decision easier of where do we withdraw from certain business and where do we also sell entities or change our mind. This has really helped us to be extremely disciplined. And when you look at the results, this is mainly driven by drilling down onto each entity, into each line of business, and managing them in a way that you can either get out of the misery of underperforming, or we need to find a better owner for that business. And this is how we manage this on a very consistent basis. The international markets, yes, there are many markets, but there is not that much capital in it. If I remember correctly, Gerald, I think it was 4 billion that is in the international markets. But we must not get or misconclude from international equals for sale. Again, international, we said, those are the markets of tomorrow. The majority of these markets will be kept, but they will be managed in a different way, which is more in a private equity-like style. And then we obviously have some markets in there that will be sold, where we reduce our footprint. And mentioned earlier, you've seen one example yesterday of Azerbaijan. Your second question was on Europe and France. France, to my mind, has really delivered an excellent result, and we often forget what the year 2017 has looked like in France. When you think about the year 2017, all you think about is Emmanuel Macron. But when you think about what happened before May, we have forgotten the political turmoil, we have forgotten the uncertainty, and we have forgotten that there was no political clarity, which has caused France to be in a very difficult and miserable situation in the first half of 2017. And given this situation, and also given the fact that the competition between the traditional insurers and the bank insurers, in particular in the area of the P&C retail business, after the implementation of Loi Hamon, has significantly increased. I personally believe that the results that AXA France has shown as a market leader, gaining market share, are very, very good results. When you look further into Europe, it is true that I would have loved to see some more growth in some countries. The UK has done a fantastic job in dealing with a very difficult situation of Octon at the beginning of the year and managing very well through the cycle. If you look at the benchmarks of the UK insurer with AXA, we should be extremely proud of what we have achieved, both in terms of growth and in terms of profitability. Belgium has delivered a fantastic turnaround case and is back on the growth track. Where I would love to see a bit more growth is clearly in Germany on the life side, and is clearly in Switzerland on the life side. If you look at the P&C side in Germany and Switzerland, we should be very happy with the results. So overall, I'm very happy with the results we have seen in Europe. If there's one area where I would like to see more growth, it's on the life side in protection and capital light. But this is clearly something that is on our agenda and that will be addressed with the new responsible, Antimo Peretta, who has a great experience of managing a fantastic business in Switzerland. Gerald.
First, going back to your previous questions on the M&A. So in 17, the M&A outflows, net M&A outflows was minus 0.3 billion. This was on top of the share buybacks that we mentioned before of 1.1 billion. So on a net basis, we could say that it was 1.4 billion to be compared with our 1 billion budgets that we announced at the IR Day. going back to the other questions relative to operating variance. Indeed, there has been an operating variance adjustment corresponding to 4 points of return on AFR. But this is AFR, meaning that it's mark to market. So meaning that any time you have an improvement in your reserve situation and an increase of your excess reserves, then by definition, it's an additional return, which is completely different from IFRS accounts. In IFRS accounts, the reserves and the reserve release has been 1.2%, as I presented it before. But what is quite interesting is to go back to the AFR report, where you will see indeed exactly what you explained about the operating variance. But on top, you will notice that in the reconciliation between the embedded value and the AFR, you have this adjustment from IFRS reserve to the BEL in P&C. And you will see that whereas 1 year ago we had a 5.1 billion adjustment, now we have a positive 5.7 billion adjustment. So we could see that it's a kind of reconciliation. It's in it. That means it's in the AFR. It's confirmed that in the AFR, but it's different from accounting, meaning that these reserves could be released at later in the future years.
So just to clarify though, so I mean, it looks like the margin over best estimate has actually increased because
yes, that's true.
Okay, thank you.
You can hand the mic to John and then we go this way.
Thank you. John Harking from Morgan Stanley. Just got one question, please. Excuse me. In terms of investment appetite, given the movements we've seen in yields, particularly in the US this year, have you changed your approach to new money in terms of investment allocation by type?
No, we didn't change. I believe that, first of all, it's a good news for us. To have rates in the US and long-term bonds at 2.95, close to 3, is an excellent news. It's a good news because, as you know, we have a gap between assets and liabilities. And our liabilities duration is higher than our asset duration. And second, because for the new business, it's good. We didn't change it. I believe that the comments that I made 6 months ago about the fact that we are moving towards more illiquid assets, high quality illiquid assets like ABS, for example, but also commercial real estate loans, illiquid products is still even more relevant. Because in the meantime, for sure, we had a nice increase of the rates, but the spreads, as you know, compressed. And this spread compression is something that we try to fight. And we try to find some alternatives in order to increase our investment income. As I said, we have been investing in fixed income last year in 17 at an average of 2.1%. And we expect, of course, this year to invest at a higher rate. Maybe it will be 20 basis points higher, something of this magnitude. So it's slow. So don't consider that. I'm quite optimistic on the fact that we won't see any more very extremely low interest rates. Nevertheless, the recovery will be slow because we have quite compressed spreads.
Thank you very much. Peter Elliott from Kepler Cheuvreux. Just 3 outstanding, fairly specific but possibly related questions. I noticed that your average in-force guarantee in Germany has come down from 3.4% at the half year to 2.9% now. I'm just wondering if there's anything in particular you've done there that has caused that. Secondly, on the solvency sensitivities, the sensitivity to interest rates is a lot lower than it was before. Again, just wondering if you could comment a bit further. And finally, on the slide that we were just on, I was surprised that the life yield was coming down sort of so much quicker than the P&C yield. I was just wondering if you could just explain that phenomenon. Thank you.
Okay.
Okay, Gérald, do you want to tackle the last 2 questions and I'll do the first one?
Absolutely. Let's start with the solvency and the sensitivity. The sensitivity is always low. It's always lower when the rates are going up. Here, keep in mind that we have the US and that we have the US, which is in equivalence. So, of course, when rates are going up, we should have our solvency going up. And here we have the effect of the US. Nevertheless, we could say that the convexity when rates are going up is a bit lower, and this explains most of the movements. About the life yields and the P&C yields, mostly for one reason. Why 20 basis points in life and why down 12 in P&C? Due to Turkey. Because in Turkey, we are investing at 8%. That's maybe the only country. Yeah, 8%. Yeah. So we are imposed with a 30% drop on our prices in TPL, but nevertheless we are investing at a higher rate, that's why it helped us. Just to give you an idea, today the contribution to earnings of Turkey was 70 million euros.
On your first question in Germany, first of all, it's very good news that the guaranteed rate comes down and actually is today below the market average, whereas it used to be above the market average. The reason for it is threefold. First of all, we have really focused our new business sales on businesses with very low guarantee, and it follows exactly what you've seen on the one slide that Gérald has shown earlier with the spread. The guarantee in the new business is very close to zero. So the dilution, I would say, of the in-force brings the overall guarantee down. The second point is you had at a time in Germany still tax benefiting life insurance contracts that are now running off. This is one part where the guarantee has come down, and then there's a third element which obviously we have done across the whole group, but particularly also in Germany, is to work significantly on the in-force and really to see how do we bring the guarantee down, because there are ways of bringing it down, and how can we also make sure that if people need cash, we can accommodate their wish. But overall, we shouldn't be complaining about these numbers.
Just come back on, sorry, just on the new business point. I mean, the average guarantee you're showing there is still 0.9, but is it the mix rather than the guarantee on traditional, or the new business guarantee you're showing there is still 0.9, which is what it was before.
Yeah, but you have to see. So in Germany, there is a particular situation. You have new business and new business. So you have the so-called dynamic, which is, I have concluded a contract in 1950, and every year there is an automatic increase of the contribution at the rates of the old guarantee. This brings your average guarantee of the new business artificially up. And then you have the new business, where we are very close to a very, very small guarantee. And that's the blend of those two.
Thank you very much. Michael Huttner from JP Morgan. And three questions. So on the US pre-IPO, which you presented on 14th November, and I know you gave the details, but could you just for simplicity's sake actually give the figure? I remember a figure of 2 billion back then, and I got confused by the numbers, and I'm a bit slow, I'm sorry.
Sorry, what figure was that exactly?
So on the 14th of November, you gave a figure of 2 billion pre-IPO, and today you gave a lot of figures, but I got confused. I saw minus 0.8 and others. I panicked here.
Gérald knows what you're talking about.
Yeah, absolutely. And then allied to that, I'm not. If you could maybe explain a little bit the cash remittance, this figure of 4.9 billion or 5.7 underlying. I don't know how you look at it. That cash remittance, as I understand it, then it includes all this pre-IPO, post-IPO. So the US will kind of come through that figure. Is that right, or is the figure we're seeing a kind of underlying? The other question is on the over-earning or under-earning, or under-reporting, really. where your reserves are increasing more than you're showing in terms of combined ratio. Can you explain a little bit where that comes from? It's really because I'd like to be able to model going forward 23% rather than 19. So if I have a bit of confidence there, that'd be lovely. And my last question is just a numbers question. You gave Turkey, so I'm just trying my luck. If you could give the contribution of the Asian JVs in AXA Investment Management. Thank you.
Gerald, 4 questions for you.
Okay. Thank you, Michael.
I'll help you if you
Thank
need,
you.
but you don't need
First, the pre-IPO. I'm sorry if I confused you, but when you go to the presentations that we made on November 13, nothing has changed except that in the net numbers that we presented at that time, it's where we had, you remember that we have 2 billion cash positive net. So it was 2 billion cash positive net, so no change. What I said is that out of this 2 billion cash positive net, this is after the capitalization of the US of 0.3 billion. That's net in the 2 billion, but there is a difference. That means that for 0.6 billion, which is also in the net 2 billion, will be reimbursed in 18 with some shares of subsidiaries that we have to keep at the group level for 0.6 billion. So you could say from an economic perspective, it's not 2 but 2.6 billion taking this into account. That's the first point. Pre-post-IPO cash remittance. Michael, the way it works is that this year we had the remittance ratio and the remittance. There was a drag for the US coming from this 0.8 billion I just described. This year, we didn't benefit from any dividend coming from the US. That's it. So, and we don't expect that it will last a long time. So we hope that there will be a dividend. But this year, it was instead of last year, we had, I remember that I told you that we have an average level of 600 million dividend capacity from the US. So instead of this, we had a drag of an injection to the US of 0.8 billion. Under-reserving or over-reserving. Let's put it this way. So long as the AFR is the AFR are marked to market and all the reserves are booked in a best estimate liability basis, this year we had I would say a decrease of the best estimate liabilities because you had good developments, good expected developments, but you cannot expect that every year you will get exactly the same. And that's why, to be honest, I said that on a recurring basis, we are much more expecting 19 or 20 rather than 24 like it was. Maybe we'll have good developments. We are always, I could say, a bit cautious, which makes that we have more positives than negative developments. But that's it. But I cannot promise you that next year we'll have again such type of evolution in our reserves. Turkey, so you asked for the earnings coming from the Asian JVs. It's right. From Asia, let me go through. Yes. So Thailand, 77 million euros. Indonesia, 57 million euros. Philippines, the Philippines 21, 15 from China.
Thank you, Michael. Let's go over to this side. Start here in the front.
Thanks, Colm Kelly, UBS. 3 questions, one on the life and savings investment margin and the guidance of 55 to 65 for 2018 to 2020. I mean, how should we be thinking about that now in the context of the actual margin of 69 bips reduce? The rate of decline has reduced year on year, the new business reinvestment rates are 40 bips higher year on year, and then in the context of what we've seen recent trends, normalization of interest rate policy and central bank intervention, should we see that target now more conservative rather than best estimate? That's the first question. Second question is on capital. Obviously, very strong headline solvency. If we think more about own funds and the growth of own funds, the own funds has been largely flat, which is logical given the focus on improving the quality of the capital. So it's a positive trend. At what point should we think about both growth in own funds and improving quality simultaneously, in the context of own funds growth being a proxy for shareholder value growth and, future distributable cash and capital to shareholders? That's the second question. The third question is on operating free cash flow. We've seen 2% growth year on year in the operating free cash flow from segments. It seems like there was a large reduction in required capital for P&C within that. I think a third reduction, without which we wouldn't have seen that much growth in that number. And again, logically thinking about this with, solvency capital on capital-intensive backbook business running off at a high rate, new business capital being less intensive, I would expect that operating free cash flow number to grow at a much higher rate. So perhaps just the reasons for the lower capital requirement for the P&C and what growth rate should I expect going forward on the operating free cash flow. Thank you.
Thank you, Gerald. If you mind, I'll take the first question and you'll do the question 2 and 3. Okay. So our ambition 2020, which was based on the assumptions, if you remember, we basically modeled it according to what is in our hands, that's the operating performance, what is not in our hands, that's the capital market, equity, and interest rates. And from there, we have taken 2 scenarios, or 2 or 3 scenarios with flat interest rates, with slightly rising, with rising interest rates. And these assumptions have always been based on a middle scenario where we have, over time, slightly rising interest rates in the US and Europe. We always talk now about rising interest rates. Yes, it's true. We see it in the US. We have clear indications in the US that it will continue. In Europe, I would say it's the first days of spring. And, the spring is not there yet when the sun is shining once. And therefore, I would be cautious still in Europe. And this guidance that we have given, and since it's 10 basis point guidance, is a guidance that was just not picked on one scenario, but on a assumption that is larger. You should keep that as a given also for 2018 and going forward. Gerald, question 2 and 3?
Yes. I'll start with question 3, and you can see it on page 22 of the Embedded Value and AFR report. And indeed, it's a very small difference because in P&C, the change in required capital was minus 140 in 2016, minus 96 in 17. So it's really a small difference, and you know that it could come from different elements, including the asset allocation, the business mix, and so on. So it's difficult. It's not a sizable, I would say, difference that could be could find the origin in its origin in a clear business decision. It's just a blended rate, and that's what I can tell you. On your second question about own funds, I just wanted to make 2 remarks. The first one, and again, it's something that you can find in the AFR report. You remember that at the last IR day, we mentioned that the life and savings Solvency II future profit, including in AFR, was 13 billion. And now it's increased to 16.2 billion, which is a quite good news, which makes that in the end, you know, and you can see it in page B55, that we have a quality of capital which improved because indeed we have it's on the screen here. You have 85% of Tier 1 capital plus 7 points, which is quite noticeable. So, in other words, it means that the quality of our capital, as measured by AFR, as measured by the real value of, in a Solvency II context, the real value of our company, clearly improved. So that means that it's earnings plus quality of capital which improved.
Farouk?
Hi there, thanks very much. It's Farouk Hanif from Credit Suisse. Just a quick question on the US RBC ratio, so numbers question. There will be potentially an increase in capital requirements if the NAIC increases the charges to allow for that. What will the impact be? And then another thing, I believe the regulator's allowing you now to use fair value for your hedges and liabilities in advance of a change in regulation on VAs. I don't know if that's true, but have higher interest rates therefore helped your RBC ratio year to date? You're shaking your head, so the answer is obviously no. A second question is just on costs. So you've got, you've still got more than half of your costs to deliver, in terms of cost savings, that is. Should we expect an acceleration, therefore, in the expense margins decline in life and P&C now? Will it be noticeable, and in which areas? Thank you.
So let me try and do question 1 and 3, and Gerald, you do 2. So on the RBC ratio, it is clear that the changes of the NAIC, and the question remains, when does it actually come in place? There will certainly be impacts on the RBC ratio. We have tried our best to anticipate with all the changes pre-IPO that we've shown you in our Investor Day in November, to anticipate as much as possible. Today, from what we know today, what will come, or most likely come, we assume that there's very little changes in what we have already done. But the question remains, it's not done yet, and it's also the question, when does it come? And obviously we are following that very closely. When we look at the costs, it is true that we are, when you sum up the 0.3 and 0.5, we are at 0.8 relative to 2.1 billion. You're absolutely right in saying you are not beyond half, but we are also not beyond half of the time. If I may remind you, we still have 3 years. It was 2016 to 2020. And what I said last year in the same place is we are operating in environments where cost savings require a certain pre-work, which is called a social dialogue. And therefore, you will certainly, by nature, see a slower start, and then you get to a normal run rate. So I would assume that what you have seen now will continue going forward. Again, our aim is 2.1 billion. We have set in November with the additional 300 million that we have shown you in November about the restructuring of the group and the regions that contribute to the 2.1 billion, we can get into an acceleration. So today I have no evidence that we should not be making those 2.1 billion.
About the VAs and the interest rates, still we can say that the rise of interest rates is deteriorates the RBC. It doesn't improve it. Nevertheless, and what I can tell you is that even if we anticipate the decision of NAIC to apply to the DAC the new tax rate of 21%, we will have in the US an RBC ratio that will be above the 500% that we mentioned at the last IR day. So I'm quite relaxed on that side, and we have a strong position, a strong capital position in the US. So that's quite obvious.
The question is exactly how does it play out, because the tax rate is hard-coded, and that is one of the pieces where we don't know yet how it's going to work. But it should be positive, as Gerald said.
Yeah, hi, it's Johnny Vo from Goldman Sachs. Just a couple of questions in relation to some of your peers that have US operations. And it's notable that within the equivalence framework, they've adjusted the calculation down to increase solvency. So this is obviously an option for you guys and would obviously boost solvency given your solvency ratio is now over 200 and the US is providing a small drag. That's the first question. Is it something that you're considering, adjusting the cal for Solvency II purposes? The second question just relates to, given that solvency is really no longer a constraint for the group, what are the constraints for the group to lift the payout ratio to the top end of the range or indeed start initiating buybacks? Thanks.
So I start with the first question and then Gerald will complement. I think what is important is to see what are the rules for the CAL. And the rules for the CAL that the IOPA has put down is that the minimum is 150. So everything above 150 is a luxury where you have the disposal of going up and down. 150 is the limit. Gerald will tell you in a minute what we are planning for the IPO.
Yeah. So, you know that we decided, and I believe that we mentioned it at the IR Day, Johnny. We have decided to recapture the Arizona business, and this recapture should take place roughly in the first half of the year, of 18. So what we did for the Solvency II calculation is that we anticipated this recapture. So long as we anticipated this recapture, it had a cost because we had to deplete, we lost a significant part of our DTAs. We decided, so long as we decided to put everything in New York and no more for GMXB to rely on Arizona, we decided to move from 300% to 200% CAL. And so this decision has been taken with the full approval of ICPR. I remind you that we have a lot of companies, including Allianz, which are at 150, as explained. It was a wash, so that means that it was a total wash. And in the end, you know, we consider that it's far better either no more to rely for GMXB on Arizona because the regulatory environment could change. It's much safer to be in New York now.
This is also one of the anticipation of the new NAIC rules when you look at what we have done in Arizona. Your second question was on the payout ratio. So the payout ratio was something that was defined based on our Solvency II framework. We have said we feel very comfortable in a range of 170 to 230. When we are below 170, we do need to think about the payout ratio. When we are above 230, we also need to think about the payout ratio. In that scale, between 170 and 230, we want to position the payout ratio between 45 and 55. When you think about dividend policy, you should always be predictable and should also make sure that your dividend policy is sustainable. I think you would not appreciate if the payout ratio would jump around every year, if the dividend would jump around every year. And therefore, my aim is to have a sustainable dividend development that is clearly based on operational improvement. It makes no sense if we're eating the stock to show a nice dividend. And therefore, you can see this year we had a very good increase in the underlying earnings per share of 7%. We have a very good solvency position. We said, fine, we can increase by 1 point, so we can show a dividend increase of almost 9%. And so we will look at this every year on year, because I think it's in your interest also to have a partner and a company that really manage the dividend in a positive way without any surprises. Andrew. Oh, sorry. We go Ralph, and then we go to Andrew. Sorry. Then it's easier from a microphone logistic.
It's Thank you very much. It's Ralph Hepken from KBW. Just a follow-up, quick one to Gerald on the numbers, again, back to the RBC ratio. This just goes back to the detail, as you just outlined, that part of the $1 billion capital strengthening previously shown on the slide to go into the US is now going to be repaid probably in the second half of this year. And that's, I think, a 600 million short-term loan. Would that not reduce the RBC ratio? Or in other words, the 500%, did you anticipate repaying that in the second half of 2018 when you disclosed the 500% on the slide?
Gerald?
Yeah. No, and this loan, this 0.6 billion loan, will be repaid in kind, as I told you. And but I can tell you that, answering the previous question where I said that I was quite relaxed on the fact that even after the NAIC would take into account the decrease in the tax rate, we would be above 500. This includes, of course, this anticipated movement.
Andrew?
Hello, it's Andrew Creanish, Autonomous. I'm going to sound like a scratch record, I think. You're talking about accelerating growth in underlying earnings, going from 4% to 7%, and I'm excited about that. I'm looking at the underlying pre-tax, which in the last 2 years has grown by 1% and followed by 1%. And that's in line with the revenues, which I think were flat. And that doesn't really look, and that's really the sort of driving force of the business. That doesn't really look like very exciting growth or within the 3 to 7% range. What's happening is your tax rate in the United States is at 1%. And I just kind of need some guidance as to where that tax rate is going. I know the element change in the tax reform will benefit you by 50 million, as you said, and that will lower the underlying tax rate. But you've got these huge one-offs which are coming through at a bigger rate. And really, if we're going to judge your performance against the 3 to 7%, we need to be able to do it against what is a sustainable rate of tax. So could you confirm that 1% is the tax rate for the States from here ever after? Or if it's not, what is your reserve of tax one-offs which are still to come to benefit you?
I remember that question from last year, Gerald.
Yes, indeed. First of all, I would like to Andrew, to tell you that when you said that the pre-tax underlying growth is quite modest, that's your message. This is not true, because we had some one-offs, and I'm sure that you had time to look at it, and you know, if you go through the MD&A, you will have all these elements. And going through the MD&A makes that it's true that the change pre-tax could look like close to 3%, but indeed, taking into account, and we could go through it when you want, and I'll be pleased to do it, we would be close to 6% pre-tax, excluding this one-off. And there are some one-offs which are in the US. And you notice that in the US we had some model change, we had some adverse mortality elements, and restated for all these elements, but it's not limited to the US. We had also some other countries. Honestly, we would be close to 6. As far as the US are concerned, you know, we still have, as you know, we had some reserves that we released, which makes that, and you can see it in the MD&A, we can see that the rate is quite low, but we don't see why in the foreseeable future it would change a lot. That means that we still have some reserves, and at the same time, when I told you just before that we would have a benefit from the lower tax rate of 50 million plus in the US, this takes this into account. So that means that we have some reserves. At the same time, the DRD, and I don't want to enter into complex explanation, but as you know, we benefit from DRD. And when rates are going up, by definition, we have more DRD because these DRD are coming from the unit-linked business and from the underlying assets. And when these assets are going up, DRD is going up. And that's the reason why you have a decrease in the tax rate in the US this year. But so long, unless you would consider that the market could decrease, nevertheless, it's something that we can take into account.
How big are these US tax reserves?
These tax reserves, I cannot, it's a few hundred millions. And you understand at the same time that let's wait for the full presentation of the US accounts that didn't take place yet, and we'll come back to you on these elements.
Okay, we can discuss it in a minute.
Michael?
Thank you so much. I'll try to ask it in a very polite way, but it's the same question you've had, which is buybacks versus deals. But Allianz, when they came to London last week, they said that one way to look at it is to think about cost of capital of 9%, and this would be a buyback versus deal decision. Of course, if an acquisition requires capital, then it might be a different number. I just wondered if you can give a little bit more indication of where the needle is bending at the moment. You've been incredibly balanced, which is very nice, but it would be quite nice too to have a slightly better kind of feel when you get this kind of windfall, hopefully later this year. Thank you.
Michael, the needle is extremely straight and will remain straight for a bit of time. Why is that the case? We are doing share buyback every year to compensate for the dilution. This will not change and will continue. The only area where we have been considering share buybacks is in the event of the IPO. And what we have said is the following, and this is still true. We have said that in case we do the IPO, we will have some funds to reallocate into the lines of business that we want to grow in. Those lines of business are health, commercial line P&C, and protection. As we've always been developing business, and as I have learned from my predecessors, that as long as you have good ideas, you should be considering the investment into these businesses. And only if you have no alternatives, you should be looking at share buybacks. We've been extremely clear. Our priority is to reallocate, but we are not stressing out about it, or we are not forcing it if we don't find anything in a given time frame. We are extremely happy to buy back our own shares. That should give you comfort that we, on the one hand, try our hardest to shift the risk profile of the group, but that we are not forcing the needle there or there. And look, at the moment, I don't even need to waste my time to think about it because the IPO hasn't taken place. When the IPO has taken place, we'll come back to your question. Andrew?
Just following up on that question, what is a reasonable time frame? Because if you get the proceeds and they're sitting in your pocket earning whatever they're earning, not very much, it's painful to you, and it is critical about time, particularly with where valuations are at the moment.
So you've given the answer yourself. I mean, essentially, a penny in the bank is a pain. And if we go back to Ambition 2020, we have promised a underlying earnings per share growth of 3 to 7%. Every penny that lies in the bank not employed is a drag on those 3 to 7%. So we will have a very strong incentive of deciding relatively quickly after the IPO has happened and the money has hit the account, what to do with the money and where the needle is bending.
Okay, grand, thanks.
James?
Not to labour the point a bit more, but I'm not that familiar with the the health market really in Asia, and therefore I don't really know what pockets of business might be up for sale. Is it actually possible to spend several billion on a health insurance company?
For sure. Maybe you shouldn't look into Asia. Look, we have a very clear list of opportunities. We've gone through every country, and by every country I mean the 10+6. We have looked at it, and we know exactly what we are after. And what I think is important is to look at it from a different angle. The money doesn't. We are not only considering to allocating the money in the emerging markets. We are also looking at allocating the money in traditional markets, because there you have synergy and there you talk about scale. Where, I mean, health in the UK is impossible because we have an issue of market share at some point. But health in other countries is very well an opportunity, and there are possibilities.
So there's no particular problem on supply, it's just about getting the maths to stack up for you. Is that right?
The supply is never obvious. You need to try hard. Are there any more questions in the room here? Blair.
Thank you. It's Blair Stewart from BAML. Just on the US, one characteristic of the results season from the competitor companies is adverse mortality, and some question marks over the integrity of some of the processes and models in some companies. And I guess you've been touched by both of those things. How confident are you that these are blips or bad luck aspects rather than structural?
Look, I mean, when you look at mortality, it is true that it is a market phenomenon, and that we have also learned our lessons also going back in the past. When you look at what has hit us, it is actually some events on the extreme, I would characterize it, and not events that are in the core of the business. I mean, the first change was very much about mortality of people that are 100 years and beyond, so that I would call on the outskirts. And the recent one was for mortalities beyond a very large amount of mortality sum. So those I would consider as outliers. The business in itself is working well, and the wheels are turning well. We have done our homework, and in particular, in the process of the IPO, we have been looking at this very carefully. And we mustn't forget, I mean, if there is always a issue in the US, if you have an experience, protection does work like P&C. You have the chance to adapt your premiums. Yes, it's not easy in the US. Yes, you are facing litigation sometimes with the cost of insurance, but it is possible. And we have taken a very clear and disciplined approach to it, not being pushed back by potential litigation. Any other questions in the room? Any questions on the webcast? You are shaking your head. Last chance for any questions in the room. Michael. Only if it's a polite one. And only if it's not about a needle.
Oh, no. But on the timing. So.
That is picking needles, yes. On the timing of the IPO, or what?
No. But let's say you receive the money on a Friday. Do we expect a press release on the Saturday?
This is a very picky question. Look, I'll answer that question when I'm in the position of having the money on the Friday. Today is not Friday, and tomorrow is Friday, but I will not have the money tomorrow. Let's come back to that question. Let's cross that bridge when we come to it. My pockets are still empty. Thank you very much. Thanks for your questions. Thanks for your attendance. And I wish you a good rest of the afternoon. Thank you.